Thanks everybody. Thanks for making it to the morning shift. When I saw I was on at 8:40, I assumed I'd be presenting to myself and potentially some of the organizers. So I appreciate everybody's diligence last night and cutting off a few hands of blackjack early. So my name is Alex McDougall. I'm the Chief Investment Officer of a fund called Bicameral Ventures. It's based out of Toronto. It's a cryptocurrency-focused fund where we raise money in cryptocurrency and we deploy it directly in cryptocurrency as well. So we're actually using crypto as our functional currency. And the thought for bicameral is, the word bicameral means something that's governed by two chambers of thought. And so all the time when we're looking and approaching an investment, we want to look at it as a standalone investment with a great management team, a great idea, a great product market fit. But we want to think about something else of it. Where does it fit into an ecosystem? Where does it fit into an industry? Where does it, if this project happens, what does that create next? And so we're always thinking about that second chamber of thought when we make these investments. So what I want to talk to you guys today about is something we call the archetype of one. And it's something where we're moving along a scale. And again, it's back to kind of our bicameral focus of putting everything in context and putting everything into kind of a longer term context. And so I want to talk to you guys today about where Fintech and where blockchain fits into this long evolving scale. And ends up where we're in a place where we can actually figure out what specifically we're trying to move the needle on to create real value. So it was a wonderful introduction. I was an ex-investment banker, joined the Fintech team and saw kind of where blockchain was moving farther and farther away from what the traditional financial system was ready to accept and how and able to sort of work with. So I left the Bank of Montreal about 9 months ago to form this venture capital fund with one of the co-founders of one of the larger technologies in blockchain called Aon, and haven't looked back ever since. Our fund's about 30, 40 million bucks depending on the markets, and we've made 5 or 6 investments so far and are very actively deploying capital. So humans are wonderful, interesting creatures. Give us a set of constraints and a set of circumstances and we'll be able to maximize within that. Individually, we can be incredibly dumb, but on a group level, and if you give us an actual set of constraints, we generally get to the right answer. So in the early days, when you just had your tribe around you, you trade with the guy beside you because that's what you knew. There was maybe somebody a 3-day walk down the road, but the friction and the opportunity cost of actually walking those 3 days down the road meant it wasn't worth it. Sure, you can make a bunch more money by trading with all these people, but the physical frictions kept you within your small network and your small ecosystem. Now, horses came, carriages came, ships came, cars started to come, and you start growing this network out. Followed by planes, trains, all of that, and you keep chunking this ever-expanding range of commerce that you have. And finally to where we're at today with the internet and mobile phones and fax and all of that. And essentially we can have a completely globally connected world. However, when you're talking to just your guy, Bill, and the tribe beside you, you know him. When you start chunking outwards, you lose that face-to-face. And you end up with these situations where you can have a complete total loss. And you as an individual entrepreneur aren't set up to handle that total loss. So where the trust friction's always been there in the background, trustee, let's go with that. But it was generally subsumed by these physical frictions. Until we solved all the physical frictions, and now what we're really left with in constraining global commerce is this trust angle. So when you trade with somebody that's right beside you and you know them, you're limited upside, limited downside. You expand to new markets at a largest return, but at risk losing everything to bad actors, and just as important as bad actors, and an equally interesting point, is bad products. If you make a red scarf and you're trying to trade with a tribe where red is the unlucky color, your loss is just as total as if it's a bad actor. And you, again, as an entrepreneur, you can deal with physical frictions that cost $100 to drive a car down there. I can put that into my operating model, I can make things happen. But you can't deal with those capital losses until somebody comes across and says, hey, don't worry about it. You give me 10% of every transaction and you go about your merry way. And it essentially becomes a trust proxy, where when you lose access to somebody, somebody comes into the middle and takes away that risk for you and proxies that trust for a fee. And it's rational centralization. It's a pooling of risk. And essentially it allows us to go from beyond just who we are talking to beside us into these ever-expanding worlds. And that's where we are today. That's how it's been working for a long, long, long time. So what are these trust proxiers doing? In the early days, it was the Medici family. They had to have a brother in Madrid and say, you know that guy, I know this guy, perfect, you guys can do it. We're the trust proxier because we're a web of people. You'd have the fashion houses where somebody has an aunt in Paris and they know the latest trend, so they tell you and you know the latest trend. And then these webs get bigger and bigger and bigger, and you end up with again, a massive global network. And this is how the world worked for hundreds of years. But every step you go out, you lose a matter of ability of trust in that actual web of networks. So it's not scalable. And so what people moved towards was, instead of who I actually know, why don't I create a model of what that person may do? And so you end up with these archetypes, and they started out being very, very broad. Men are like this, women are like this. And it gets more and more granular as you go. Men between this age are like this, women between that age are like that, and have these tendencies and these habits. And all of a sudden, instead of trusting that guy who that guy knows, you're able to trust, or you're able to have some degree of trust in the entire world just based on data points. And you end up with these archetypes. And that's where we are today now, actually. We've moved from these web of individual networks, which used to be the competitive advantage, to these web of archetypes. And whoever has the best archetypes, now it's the Googles and Facebooks of the world, are able to capture the most value out of the system. And so what we're moving towards, and what we want to move towards, is this concept we call the archetype of one, where you can get so granular in your archetypes that you can know every single thing about a person in a completely anonymized way that allows you to transact like you did with Bill and your tribe, but on a global scale. So if you can create these with better data, with more trust in the data, you can get more and more granular on this, and you can start to eliminate and pull out those middlemen who are essentially centralized trust proxiers right now. And you can create this web of archetypes that are direct peer-to-peer value transfers. And that's the platonic ideal right now. We're not there. There's many, many barriers to where we could be getting there. But what we are trying to move towards, and where we try and invest a lot, is projects that are moving the needle towards this archetype of one. Because we believe that's solving the last trust friction and what creates real sustainable value. So this is how we kind of think about the world on this trust versus capital scale. When you have a lot of trust that's gapped, you need a lot of capital to plug it. That's how essentially these trust proxiers work. Is they say, okay, well, I don't actually know that physical person, but that model tells me that they have a 10% chance of defaulting on whatever obligation I'm backing. I'll put a bunch of capital against that, and we'll run our business. Capital is expensive, so when there's more capital required, prices need to be higher, margins are lower, and it essentially keeps commerce kind of constrained within a certain set of circumstances. So less trust required, less capital required, lower costs, more people included, more capital freed up, more value created in the real world. Now, this orange box at the bottom is something is a very important point. You're never going to get to a situation where it's an entirely risk-free business model, obviously. No matter how much you trust somebody, or no matter how much you know the person, there's always going to be that actual business risk of earthquakes, mechanical failure, that type of stuff. So I always think about this as systematic and non-systematic. It's inherent versus trust risk. You can reduce one, but you can't reduce the other. So, Fintech's done an amazing job of moving this needle along the scale. Where we think there's real value to be gained here is when you can add more data for the same cost to allow yourself to get more granular on the archetypes that you're looking at, have more accuracy and reliability in the data that you are looking at, again, to allow more granular or more archetypes, better understanding of archetypes. And when you're actually able to generate more model data to really move the needle more towards that archetype of one. So Clearbank's a fantastic example. They're a data-driven lender out of Canada that uses sharing economy outputs like Airbnb, Facebook ad revenue, those types of things as inputs to their lending model to allow people so they can lend to entrepreneurs who are otherwise entirely excluded from sort of the traditional lending economy. So if they were able to get a loan, it would have been at 30, 40%. Now Clearbank can do it for 15 to 20 because they've come up with this new way of collecting data and applying it in a new manner that wasn't in existence before. Lending Club's another great example. I mean, there's always challenges with the crowdsourced lending platform, but from this construct, they give you the ability, whereas it formerly was one person analyzing a set of data, now it's 1,000 people analyzing that same set of data. And generally, when there's large numbers, we get to the right answer in the end. So where blockchain takes this to the next level, and this is the projects that we like to focus on as well, is immutable data. Once it's actually created, and once a data point happens on chain, it's spread across 1,000 different ledgers, and I won't get into the technical aspect of blockchain in this presentation, but that data can be trusted 100%, 99.9%, never say 100. And right now, a lot of our data collection is static, and it's incented in bulk. The incentive for you to sign up for Facebook is you get a free platform. Maybe it's worth it to you, maybe it's not, but we haven't really figured out the right way to do it. With blockchain and micropayments and decentralized logic, you can collect data in real time and pay people for exactly what they're doing, rather than these big bulk incentives of give us everything and we'll give you a free platform in return. That's a much, much better model and a much more sustainable way of collecting much more targeted data as well. And finally, the sovereignty of data. This is really the key to breaking it from those web of archetypes to the archetype of one. When the data turns around and becomes yours, instead of you giving it to somebody else, so it flips the model on its head, where I am now the data source and the data owner and the data collector, and applications need to interact with me, and I choose where my data goes and I choose how this goes forward. So blockchain's moving the needle. Fintech's moved the needle a lot. Blockchain's moving it as well. Now the second angle to this is the other direction. If in the absence of more data, you can figure out a way to still transact in a trustless manner, it essentially takes it from I trust you to I trust the transaction, and I don't need to know you. And this is an entirely separate concept than trusting these archetypes. And so this is where blockchain initially became kind of the value proposition. You hear the term trustless world all the time. You don't need to trust the counterparty. But you still need to trust that you're making a good product for them. You still need to know what they've done in the past. This data angle and all of the other value aspects of the last slide still are incredibly applicable in the blockchain world. But this allows you to try to go the other way on this chart and create value and lower capital required and lower the cost of actually running this platform. Peer-to-peer exchanges where you can send something and it decentralized triggers a payment back to you. Prediction markets where you don't have to rely on a third party to pay you. And digital goods where you can send something and just the fact that it arrives triggers a transaction back to you of payment. So you can take out a lot of these middlemen and take out a lot of these digital trust proxiers. So this is our oyster playground world. We weren't quite sure what to call it. The projects that do both. The projects that create value by moving the cost of creating better data down, and also move the ability to transact when there's less data down as well. So we work with a blockchain called Aeon that's designed to be interoperable in a web of blockchains across networks, which essentially allows you to create real-world business models, whereas in a one-by-one blockchain world, you create these data silos that you can't talk across them, and that's better than what we have today, but it's not where we want to go. Clan Play is a fantastic gaming platform that essentially turns the game that you're playing into an oracle that creates data points, so it allows you as a player to create a valuable gaming profile and take that profile out of a game and move it into other games. So developers can find certain players who are looking to or certain types of players to play through their games. Advertisers can hone in on specific types of people that they want to advertise to and incent specific actions. You can find other gamers who are really good at the game that you're playing and build a clan together based on real value. So it's that allowing the data that you're creating to accrue to you and creating real value out of it. Vault Wallet essentially is a wallet that allows you to hold your data and become that self-sovereign owner of your own data bank. And so I can go through the rest of these projects at some other point as well, but I want to leave a few minutes for questions. So what does this mean as an entrepreneur in fintech? think through how your product is actually creating value within this framework. And also think through where that value is accruing to. If you're creating value, but it's all still being captured by centralized trust proxiers or by a certain part of the value chain, that's great. More value in the world is better than less value, but think about how it's accruing through the value chain as well. You can create new profitable niches by just understanding an archetype better than somebody who doesn't. So lending, Clearbank created a new archetype of these new sharing economy entrepreneurs, and they've made a niche that wasn't economic before just by thinking through something in this model. Think about how to acquire more data for less, how to trust existing data better, and how to operate when there is no data, and turn that into a business model. This is an interesting one. People who already have stashes of data still need to are still subject to this kind of whole framework. So there needs to be a value proposition within your model of why would I give up my stash of data that's my moat and my value proposition right now? And that's a challenging one. It essentially requires some second or third order thinking of you're giving up access to your data in order to get access to all data. But you need to then compete on an open and free playing field, although you'll have access to way better resources in order to compete on that open free playing field. And that's a challenging aspect to get there. And that's one of the things that we're all trying to work on of how to open up the flow of data and how to open up the freedom of data. And finally, capital is expensive. And I come from the investment banking world. A lot of you guys are in sort of the capital industry in various parts. If we spent a quarter of the time that we do manipulating capital and figuring out how to apply it better and how to do this and do that with it, on just figuring out how we need less of it to do the same things that we do today, we'd be in a way better spot in the world. So I think that's what I'll leave you with, is figure out ways to reduce capital from the system and we'll all be better off. Thanks very much. Happy to answer any questions.
Yep. Craig Spielman, Risk-Pal. I'm in the risk business. One of the big things that has been in conflict really is being anonymous and also AML, right? And what do you see as a balance between that? I can't figure it out. You know what I mean? And if you look at AML, it's real serious. Human trafficking, terrorism, drug cartels are being supported by it, and firms are being, hit with billion six. I think somebody's being hit with 100 billion today.
Yeah, no, it's a great question. Where I think it gets to is that in a perfect world, you as the human entity of you is anonymous, but all of your actions are digitally available and digitally imprinted into this archetype of one. So while you as a person is the anonymous part, you actually are far more exposed to what's actually you have been doing as a actor in the various parts of the world. So I mean, in running a crypto fund, we have auditors who are not used to auditing crypto, and crypto is kind of a challenging concept to get their heads around. But and I don't want to say in reality because there's lots of nuances to it, but every coin that is in my fund, I can trace back to the minting contract that actually created it. I can trace it through wallets. I know who most of those wallets are. You're a hash that is pseudonymous. So it's actually much more auditable than cash, which is we have developed ways of proxying around figuring out what cash is, and kind of suspicious transaction reports and all of those angles of trying to figure out how to do it for cash. And with crypto and with kind of the blockchain side, you actually have all of that visibility. So I totally understand where you're coming from, and I think it's kind of moving that mindset and thought forward to figure out the last step of applying what we do for cash today in a crypto mindset and just acknowledging that we now have more data, but we still need to have thought processes and there's suspicious transactions, and we still need to have that last kind of mile on it. But I totally get what you're saying.
Thanks, that was great. Thanks, Tom.
Appreciate it.
Hi, my name is Jessie. I'm with the senior consultant in Calgary, Alberta, and Vancouver.
Fellow Canadian.
Thank you. So we run a comprehensive multi-family office business model.
And I see so much inefficiencies in the time that I, as an advisor, and our company is, I want to say, wasting, because the legal side, the financial side, the tax side, they don't communicate. And even spending hours, like we have a client right now, we spent 6 months dealing with CRA, it's really fun. And they're siloed. And they're siloed.
They're
and they call you, one guy calls you, and the other guy says, I don't even know that the other guy's called you. So there's so much time lost, confusion, expenses. I would say our clients spend hundreds of thousands of dollars telling the same information to 5 different people.
That's amazing.
Yeah, so I'm trying to wrap my head around, I haven't really understood how blockchain really works because my consciousness only hears about blockchain and this crazy cryptocurrency stuff, which I'm not interested in participating in. But I want to understand how we as a company can change the future of financial planning for individuals. Because the conversations around these fees is nonsensical because really where all the money is being wasted is paying the same person 5
Absolutely.
times. Right?
100%.
So how do we incorporate blockchain into our business practice as a way of transitioning our firm into the future ahead of the curve?
Carefully.
Yeah.
No, it's a fantastic point, and there's just even before this this presentation, I've been talking to a few people in the room, and there's a couple people who are working along this type of vein of figuring out ways to automate your contract payment, figuring out ways to hone in on the unique ID of everything that happens. And so I think what I'd say is the platonic ideal of blockchain is that you have a complete ledger of every transaction that's happened. And anybody can see it and anybody can trust it. So that theoretically, whereas right now within the CRA, there's the payments guy and the call center guy, and they have no way of talking to each other. In full blockchain world, and again, this is kind of the rosy colored glasses future, they would all be able to see every transaction that's happened. There would be a layer of abstraction on it that takes all those transactions and puts it through kind of the usual tax filters that we have right now. And they'd be able to look, they'd see what each other did or whatever the interactions were with you, and they'd be able to essentially drill down into every transaction and trace it back to the original actual source transaction. So right now, for audit purposes, the auditors come in and they look at 2 to 5% of your transactions and say, well, the rest is probably fine. This essentially gives you 100% audit trail and 100% ability to sort of check back on those things. So one of the first projects that Aon worked on was actually an enterprise side with the Toronto Stock Exchange. So what they did was they worked with the natural gas exchange, whereas a lot of forward contracts and futures, and it's a contract that's traded and traded and traded and traded and traded. And then if gas doesn't show up at somebody's door, it took them between 30 and 45 days to go back through the system and figure out who screwed this up. And so what they did to solve that, they put a buttload of money in the middle and said, don't worry about it, here's our money, you're fine, we'll figure it out on the back end. That capital, right? And so what the blockchain angle was essentially create a web where every single transaction and every single transfer of that of those contracts, and you can even go down to kind of the molecule of actual gas, is available and freely distributable, and everybody can see what's happening. And so they took that audit time from 30 to 45 minutes to 2 to 3, or 30 to 45 days to 2 to 3 minutes, which is massive, massive orders of magnitudes of savings. Now then, TMX sold the natural gas exchange site, so they haven't moved forward on that. But there's these, blockchain adoption is challenging. It's a complicated technology, which is annoying, and I think in 5 years, we were talking about this before, that in 5 years it's just going to be seamless in the background. It's way too public right now for how deep it should be in the tech stack. But the upside of things like that, where you can take it from days to minutes, that gap means that this should be something that is on everybody's radars of just the potential opportunity of this industry. It's a game changer for so many ways. How are we doing for time?
9 minutes?
9 minutes?
Yeah.
Sweet.
Yeah.
12. there will be supporting standard compliances, say IFRS or AAC, depending on geographies globally. Now, today which have become mandatory for each and every corporate or enterprise to adhere to, right? So, is blockchain as a model for its transaction side to understand, but eventually that consolidates to revenue or distributions or whatever it could be, right? So, are there standards that IFRS or CASB or ASB, anybody that are already released for this, or is it really in the early stages where this is figured out?
Accounting for blockchain is one of my favorite topics because we've had hours long conversations with our auditors about how to do it best. And so the short answer is no. There's no official standards for this. But there are some publicly traded companies who, most of them are miners. Most of them do a terrible job of accounting. And if they were gold miners, they'd all be in jail. But there are some standards that are going in the right direction. Every accounting firm essentially has their own take on it. Whether they look at crypto as inventory, or a intangible asset, or property, or a currency, or commodity. And so the way we think about it in terms of running our actual fund is as inventory. So when we get it in the door, it has a cost base. And when we sell it or give it to somebody as salary, or I pay myself in crypto, or we invest it, that has now a new value of it. So if there's a gain, then we treat it as revenue. If there's a loss, then we treat it as an expense item. So it's essentially as if we're running our fund based on shares, but shares that fluctuate wildly in value on a regular basis. And that's the way that's where we're at with the industry right now, is crazy new technology, current world way of thinking about it. How do we bridge that gap? How do we fit this into the buckets that currently exist? And it's ugly and messy, but it's progress. That's kind of how it has to happen. And we're making it work. It's other companies are making it work as well. There's always ongoing discussions and standards battles between the accounting firms that we should treat it like this, we should treat it like that. It would be phenomenal if regulators would be a little bit more proactive in it. There's certain regimes around the world that are doing a very good job, Malta, Singapore, Switzerland, of being sort of thoughtful, and for Gibraltar as well, of not being like, we don't care what you do, just come here, everything's great, but more being like, we understand the technology, we're putting in place a principles-based system to move this forward, where you can have some regulatory certainty. Is always challenging in this industry, but you can have some kind of regulatory certainty. Whereas I think North America has been a little bit more of a regulation by enforcement, where you look for bad actors, you regulate them, and you make laws that make sure people don't do that bad action again, which is a little bit of it's not the most thoughtful way of doing it, and that's kind of the way we think about regulatory regimes, is thoughtful versus less thoughtful. So it would be awesome to have some clarity and have some more battles on this, but we're in early stages of it.
Thanks.
Great, well, thanks very much, guys. Much appreciated. I'll be around.